This is the Daily Market Comment by Marios Hadjikyriacos. I'm Maria Pachotidis. Thanks for joining us at XM.com. Another scorching hot inflation reading from the U.S. unleashed havoc yesterday, sending traders scrambling to recalibrate the trajectory for interest rates. Inflation, as measured by the CPI, accelerated to 9.1% in yearly terms, the fastest pace in 4 decades. Most concerning is that price pressures are broadening out beyond the usual suspects of food and energy, creating a bigger headache for Fed officials trying to slay the inflation beast. Once the dust settled, market participants concluded the Fed might raise interest rates by 1% at its next meeting in 2 weeks, a scenario that Fed funds futures currently assign a 55% probability to. In other words, a 100 basis points rate hike in July is now the baseline according to market pricing, and if the Fed doesn't push back, it is essentially endorsing it. With traders split on how hard the Fed will swing this month, a speech by Fed Governor Waller today at 1500 GMT could be pivotal, as he is one of the last officials to deliver public remarks before the blackout period begins on Saturday. In the big picture, it is striking that the more the market anticipates rate increases to be front-loaded this year, the more rate cuts are priced in for next year. Since investors are interpreting today's rate increases as next year's rate cuts, the market reaction was peculiar. Treasury yields fell in the aftermath, while the dollar took a step back, despite the upside surprise in inflation, with the unwind of protective hedges after the event likely contributing as well. This allowed euro-dollar to defend the parity line. Whether it holds might ultimately depend on the path of energy prices and whether Russia really cuts off the gas to Europe next week. For similar reasons, stock markets also held their ground. The S&P 500 lost only 0.4% and the Nasdaq even less, which is a relative victory considering the seismic moves in Fed pricing. With the Bank of Japan being the lone wolf that is not considering higher interest rates, the yen has been steamrolled as capital flees the nation in search for higher returns abroad. The yen resumed its downtrend today, bringing its year-to-date losses against the US dollar to a staggering 20%. Elsewhere, the Bank of Canada caught the markets by storm yesterday when it delivered a supermassive 100 basis points rate increase, adding credence to the view that the Fed might follow suit. This was today's Daily Market Comment. Thanks for joining us at XM.com.